episodes of Westwood Capital LTV, it probably makes sense to have for the first one, have a bit of an overview of what it is we do here at Westwood Capital.
Yeah.
Obviously, people know we're a bridging lender, but some people might not know much more than that. So, it might be sensible if you give an overview of what bridging is, what we do, what types of deals we do, what type of assets we do, and why people would want to use us as opposed to other forms of banking, I suppose.
Yeah, absolutely. We're pure bridging and refurbishment funding financier. We offer bridging loans against property assets, that can be commercial or residential. I guess one of the biggest things that makes us so different is we're working off open market values.
As opposed to what we work up open market values, but what does that?
So that is the true market value with vacant possession of a property. So for a residential asset, that is a property with no tenant, with as an empty property. And when we start talking about commercial properties, we're talking about business assets removed, not trading. So if we're talking about a pub, for instance, it could be the asset that the tables, the F&M has been removed, and that there is no license, and it is the bricks and mortar of the building.
But I suppose other lenders, for people who don't know, that valuations have different levels of valuations. There's the open market value, which is what we work off, but then there's 180 day. If that asset has to be sold within 180
restricted
days,
periods.
So 6 months, and then a 90-day value, which is 3 months, which of course all of those are low end. Some lenders restrict their loan to value against that restricted value, which in turn means the client can only get a smaller loan, doesn't it? So we work off open market value, which means the borrower can get more.
They're maximising their particular loan with us, I think is the best way of looking at it. So commercial or residential assets, buy-to-let portfolios, and the reasons for that can be for buying assets to put into a further property portfolio, leveraging off other assets for that, having a hunting fund for people to go out. It could just be for a cash flow for a business. So the reasons why somebody might use bridging finance with us are not necessarily just for property purchase. It could be for business acquisition, all the way through, like we've already said, cash flow, etc. Our security is always the asset. I think some of the biggest things that we're looking at is the applicant, the asset, and the exit strategy, and that's what we do very, very well. I think is look at, and we look for all three of them.
I'd be right in saying as well that we a lot of the deals we are seeing and financing are not necessarily because they can't go and get finance elsewhere with a more mainstream bank, but potentially because they can't get it fast enough.
Yeah, absolutely. I think a lot of people have opportunities to purchase property or have opportunities to make money within business, and that opportunity cost isn't met fast enough by the banks generally. So they're looking to us as maybe an interim finance short. At the end of the day, we are short term from 3 to 24 months. Our average deal is probably around 9 to 12, and that a lot of our exit strategies are that there is a refinance put in place, and we're giving time to allow an asset to be purchased or a business decision to be made, but then the longer term for us to be able to be refinanced out.
Yeah, so then that gives them the time and the space to get their incumbent bank, for example, to take them out and go through the application process, which generally takes anywhere from 3 to 6 months. We've seen even longer, haven't we? So,
up to 9 in some cases.
So while they're going through that process, it doesn't mean to say they can't make that purchase or take advantage of that opportunity now. They just do that with us, and then we get refinanced out. So I think sometimes there's a perception in the market that bridging is for things that can't or shouldn't be financed or need developing in the first instance, when actually we're not seeing that. Where we're seeing cases that have no problem getting finance, it's just they can't get it quick, can't get it fast enough. Exactly. So there's that. So from a costing perspective, then, I mean, again, one of the misconceptions I feel with bridge funding is that it's fairly expensive. But of course, with the recent bank interest, the Bank of England base rates, going up, that means that traditional funding is more expensive. So even though our rates haven't really changed since the business was established, I think comparable, we've become more competitive by the fact that the alternatives have become more expensive over time, haven't they?
Absolutely. I mean, you look at bank refinance, which as I've already alluded to, a lot of our exits are bank refinance. It's maybe 2 or 3% per annum, more expensive than us, which a lot of our clients, and we've got some clients who are actually buying and holding with us and renewing with us on properties because they want to see where the base rate is going. They don't want to tie themselves into a 10 or 15 year product at today's rate, and are quite happy paying us slightly more. Hopefully in the long term they'll get some less. And for those types of deals, for us, the asset's good, the applicant's good, the exit strategy is there, it's just when. And actually they might be servicing our interest through rental income or rental roll or existing business profits, and that works really, really nicely for us. And I think that interest rate rise, there is a massive misconception that you go to bridging, it's the lender of last resort, but it really isn't. Used correctly, we're not that much more expensive, and actually over a longer period of time we can actually work out to be in line.
And we've also got some cases as well where they have or do have the ability to refinance elsewhere with cheaper mainstream funding, but they've chosen not to because traditionally and generally that mainstream funding requires a capital and interest repayment profile, which actually means it's a lower interest rate, but the monthly repayments are high because they're making payments off the actual capital of the loan, where of course we set interest only, which means that even though our interest rate's higher, our loan repayments per month are much lower. So we've got a couple of deals on the books where they're actually sitting with us because cash flow is actually a little bit more important to them at this moment in time than the interest rate.
It could
which
be
is another reason, isn't it?
Some of them are trying to repair a balance sheet, maybe. It could be that some of them are just looking to get some cash back in the bank, give themselves some time. With one of our biggest deals is doing exactly that. And I think that what we can do is, the interest rate, the interest per month, because they're not paying any capital back, gives them that ability, again, gives them time. It might only be up to a maximum of 2 years, but then that allows them maybe access to cheaper funding than if they were to go get a mortgage right now. It could be at a much higher rate than even we are. So that's another great reason for bridging finance.